Welcome to Everything Money. Today we're talking about Oracle. Paul, I just told Mo off camera, like, I feel like Oracle is one of the biggest companies around, yet quietly, Mo, I don't know much about it.
Sleeper.
It's yes, like I know the Oracle, they sponsor is it the Lakers?
No, it's the Golden State thing.
The old arena was the Oracle arena.
Okay. But this is a software developer. They give me a second, sorry.
SaaS developer, they do software for businesses.
Yes.
That's why we don't hear about them a lot, because it's not like Microsoft where you use every day.
Yeah, database technology software to enterprises around the world. They have 430,000 customers in 175 countries, Paul. I mean, a huge, huge company. Today we're going to use our 8-pillar analysis to look at the financials of Oracle and then see if the financials transfer into an appropriate stock price. We're always looking for great deals out there. Hopefully it's undervalued. In this market, Paul, rarely are they. And I can almost look at the chart and say, yeah, it looks like a little parabolic spike there.
After the COVID crash.
Yeah, give us your thoughts on Oracle.
But here's what I get to first, guys.
Go ahead, Paul. Oh, look at that. There we go.
In 2000,
yep,
$42 a share. In 2014, 2014, December, $46 a share. So guys, 14 years, it went nowhere. Let's look at their financials. Income statement. In 2000, they did...
Oh my gosh, come on.
$11 billion, sorry, $10.5 billion in revenue.
10.5 bill.
In 2014, they did $38 billion.
Almost four times
So almost
as much.
4 times the amount, and their stock was flat. Another example of when you overpay, and when stocks are overvalued over the long run, it doesn't matter if the company grows and grows and grows. If you overpay, that's the case. Why not pay $5,000 a share for it? As long as it's growing, it'll keep going up. That is not the way it works.
This is a great point, Paul. Go back to the ticker price and the graph there. So the point is, folks, is we're in this huge bubble right here behind Paul around 2000, where you might very well be overpaying for a lot of companies that everyone is talking about. And so your returns over the next decade could be nothing.
Or negative. They were negative over the next decade. Look at them.
If you're buying
it fell in half
at the wrong time. So we'd like to show you
wrong price.
Wrong. Oh, go ahead, Paul.
Wrong price. Remember, I don't care about the time you buy. What I care about is the difference between price and value.
That's right.
Here, price was way higher than value. Value is probably down here.
I see.
And guess what? If you look at this, might be able to make the argument this is the value. Overpay, it goes back to value. That's just the way it is, guys. If you argue with me on this one, you just hate history. And I'm fine with that. Go hate history all you want, but you will learn through history at some point the same things that happen in history. If you overpay, the argument I make is, if it was going to triple and you were sitting here saying, well, it's going to go better, then why not pay this? You have no better argument for paying this versus this.
That's true.
Versus this, versus this, versus this. That's just it. So anyways, let's go back to our 8-pillar analysis that we use our custom software that you can get on the link below at everythingmoney.com, where you won't pay tax and you only be charged once per month, or you can join our Patreon. So anyways.
Pillar number 1.
Well, first off, $270 billion market cap.
Jeez, yes.
Pillar number 1, we want the 5-year PE being less than 22.5. It's 27.5.
Uh-oh.
That's an X.
Nobody got time for that.
Pillar number 2, which is to be expected, 12.8% return on invested capital. We want it greater than 9%. So that is a check. And software companies tend to have very high returns on invested capital. Dividend, Uncle Seth, 1.2%.
Cute.
$3.2 billion. It's about the market number.
And they have plenty, Paul.
And they have plenty. Remember, guys, you have to compare their dividends paid to their free cash flow. Here's what I love. Look at their 5-year free cash flow. Look at last year's free cash flow. Pretty much exactly the same.
Yeah. Wow.
I actually love that. To me, that just shows consistency, and it shows that people are probably going to hate it. This PE shows that people don't hate it, but the bottom line is they have plenty of cash to pay that dividend every year.
Pillar number 3 is revenue growth over the past 5 years, Paul.
$38.3 billion to $40.8. Check mark, barely. I wonder how many that was acquisitions. How much of that was acquisitions? Look at 10 years ago, $37 billion to $40. So they're only up 10%. In revenue growth in the last 10 years. Not the greatest. Not very sexy.
Profit growth over the past 5 is pillar number 4.
9.76 to 14 billion.
Oh,
check
boy.
mark there. Shares outstanding. Uncle Seth!
Pillar number 5, Paul.
4.16 down to 2.77.
How can that be?
Jesus H. I mean, they're buying back a lot of shares. Guys, I think Problem is, they're a very expensive company based on the 5-year PE, so we'll go look at other metrics and see what happens.
Pillar number 6 is total long-term liabilities divided by 5-year free cash flow under 5. Can they pay off their debts, Paul?
So here's what we do. We take the 5-year free cash flow from the main page, 12.55, multiply it by 5, and we have $62.7 billion. Somebody verify that for me. Yes, I'm right. So we want their long-term liabilities to be under this. 62.7 billion. Why? Why, Seth? Is this one of those things where I'm going to ask you 80 times before you finally get it?
No. You bring up very. I digress for a moment, folks. Paul brings up examples all the time, and then when you're repetitive with the examples, people will bust you up in the comments. Like
will they?
Oh, yeah. So you'll say, for example, myself and my neighbor, we all have the same assets, except my neighbor has $10 million in debt. Who's going to survive a crash? And people write like, who in the hell has $10 million in debt? Who's your neighbor?
The point isn't that, guys. The point is two people, fine, call it $1 million in debt versus 0.
Thank you.
Whatever it is, the point is a company or a person with less debt is more likely to survive bad times. And in the world of investing, what matters is survival.
Yeah.
Okay? Buying good companies at a good price, they can survive. So we go to their balance sheet. We scroll all the way to the bottom.
Please do.
Whoa.
Uh-oh.
$100 billion in debt.
Whoops.
Ain't nobody got time for that.
Wowzer.
That's awkward.
That's really awkward. By the way, do you know Oracle just moved their headquarters from San Jose to Austin, Texas?
Yeah. Everyone's doing this now.
But you're right. Taxes don't matter. People don't care about that. Cost of living doesn't matter.
Should we do it again?
Tesla too, right?
Should we do it again?
Oh, God.
If you don't know, we had a private live stream in which we started talking about taxes, and I said, are we going to start talking about taxes? Seth said no, and Tim said, yes, let's do it. And I went on this rant. It was our most popular live stream.
It was
I still got compliments this weekend about it. Guys, the 7th and 8th pillars have to do with free cash flow. I like free cash flow over earnings. Why? Earnings are manipulated by SEC rules, accounting rules, etc. Cash flow can still be manipulated, but it's a lot harder. Cash in, cash out. So we look at the free cash flow, which is cash from operations less your capital expenditures. Again, part of our software that's exclusive. We add this line here to make it easy for you. You only get this on our software along with videos. Every day we put videos up there just for our users. It's only 90 cents a day. Click the link below. It's a no-brainer. 90 cents to get all of this. You'll see more as we go along with our stock analyzer tool. 12.6 billion to 12.56. Technically, it's an X. Mm-hmm. So not having any cash flow growth. I mean, look at the last 5 years there.
Oh, it's going down.
Yeah, it's actually going down. So then the last pillar, we take the 5-year average free cash flow, 12.55. We multiply it by 20. Most common question you get is, why'd you pick 20? Guys, 15 is a reasonable number for free cash flow, but we're looking at a 5-year average. So I want to pay a higher amount, especially if free cash flow is rising. I don't want to penalize the early years. So I pick a higher multiple to account for the previous years as it's growing. So 12.55 times 20 is 251 billion dollars. What's the market cap?
268, Paul.
Okay, so it's still an X. Mm-hmm. But the thing that I have an issue with this company is there's no growth.
Yes.
We're going to use, so here's the 8 pillars tab that gives you all the information we talked about. It kind of starts off strong and then, guys, we have a stock analyzer tool that we're going to put here after Mo goes through the charts. It'll tell you exactly what you should pay based on your assumptions for growth, etc. This is not a fast-growing company. You cannot pay a big multiple when the growth is not there. If the company is growing 30% a year versus another company growing 2% a year, which one should you pay more multiple for?
Of course.
30% a year.
Maybe even that 20 multiple for pillar number 8 there was not too
it's too high.
Too frothy?
Yeah, too frothy. And it didn't even hit that one. I just think this is an expensive company based on what I see, but we'll see the stock analyzer tool.
Mo, were people trading this in the Bidness Nation?
They were a lot during COVID. Now, I'm going to just point out that we're overall 4 major moving averages, and you can kind of see that the volume is declining. So I just want you to be aware of that.
Noted.
So you have good news and bad news. Now, also, you're at all-time highs, and you're challenging that all-time high today. So the good thing is that you've been going since April over here and just going sideways and increasing in price slightly. Now, I said declining volume. That's not good for trying to break out to a new all-time high. this is a tough one for me because I like the company, but getting through these all-time highs, and you can tell even when it got to this all-time high, look how it just stayed stagnant. It took July through October to break up there. Just last week, 2 weeks ago, to break through that level. So you see what needs to be done, even as your trend was very good up here. So this is a hard one. I don't think I would be adding at all-time highs. I could be totally wrong, but I think there's better options out there for you.
Paul, what you doing over there with that stock analyzer tool?
So in this one, guys, you can pick up to 3 assumptions. I'm only picking 2 because the company's been around for so long. So I'm looking at a 7-year analysis, and I'm making some assumptions here. This shows you our 1, 5, and 10-year numbers. For revenue growth, I put in 1 and 1.5%. Remember, my goal is to be conservative when I'm doing my numbers, and I don't want to sit there and force a deal to happen. Share buybacks. They're buying a lot of shares back. I should probably make this low number actually a little bit higher because they're clearly going to buy more shares back. Profit margin, 24 and 25%. Free cash flow. PE. I actually feel for PE, I should go lower than this. Hit the analyze button. The stock's currently at 97 bucks. You ready, folks?
Uh-oh.
Yeah. I mean, this is obvious. It's just overpriced. We need it to fall in half. And you might sit there and say, oh my God, fall in half. My guys, well, the PE, the 5-year PE was 28. Falling to 14, okay, makes sense. I still think it's a little much because the company's not growing. Look at this. Over 10 years, guys, the revenue growth is 1.1% a year. 10-year basis, 1.1% a year. Come on. So I look at this saying, just overpriced. I do like the company. I like the fact they moved to Austin. Their CEO is older, Larry Ellison. What is he, 75 or so? He's getting older. I don't know how much this is going to change things if he decides to croak. Do people decide to croak? How does it work?
Sometimes.
Yeah.
So anyways, my position on Oracle is a lot of debt and a bad multiple. I would be avoiding it.
Yeah.
A lot of debt. I can't believe that debt number. That's a huge number.
Final take, Mo?
Very large number of debt. I don't know if I've seen a larger number of debt from a stable company.
I would have thought,
like
I guess, if I were to guess, I would have thought 30 billion max high side on debt. They have 100 billion.
I mean, we see that kind of debt with smaller companies.
I think there are better software businesses out there to buy at better values that have growth potential.
That's our take on Oracle. We will update you in the future moving forward. Big company, good company, but at the moment, it's a no for us. At the moment, better companies out there. So fondle a thumbs up. Check out everythingmoney.com. Join the community, and you can have that software right now. Talk to you soon. Thanks for watching. I love you.